All right, hey guys, this is a super important video for anyone into finance or trading or stocks. This has to do more with, first off, the housing market, but then it does parlay into the stock market. Okay, so what's important to know is back in 2022, I predicted a market crash using the Michael S. Jenkins 2,339 day market cycle. It recurred at like December 26th of 2021. And I'm looking at the real estate, but I was at the time obviously like looking at stocks. But December 26th of 2021 was the recurrence of that cycle. So literally right on this day, there was a recurrence of the cycle saying the market will make a major pivot. Since there was a bull market up into that point in stocks and in the real estate sector, what does that mean? There was a crash. It's going to make a reversal and there's going to be a crash. Okay, so I predicted it. I was new to trading at the time though, so I didn't bet a lot of money on it because I was aware of that, but I didn't capitalize on it because first off, I didn't have a lot of capital at the time, and second of all, I didn't really know how I would capitalize on it because I didn't understand like puts that well back then. I did understand puts, but I knew that theta decay. I didn't like time decay, and shorting index. The index was like weird. So anyway, I didn't know really about futures back at the time. If I'd known about futures, I would have tried to hold a futures contract short. But anyway, what's important is I predicted a crash, and then I was like, okay, well, let's see if my prediction's right. And then I watched a crash unfold that year, and I was like, wow, okay, that cycle really is true. Okay, but what's important is that early on in that crash, I'd say somewhere around here, I got physical mail from Wells Fargo. Wells Fargo's my bank, okay? Now, I was a low-income person back then, very low income, so they had no business really sending me the mail that they sent me, which was a brochure about locking in a variable rate mortgage. So, and if any of you aren't aware of this, the federal funds rate had been cut to 0% during the COVID crash. So interest rates were at essentially zero. Now, banks charge a higher interest rate than the federal funds rate. However, there's a bit of a rubber banding mechanism, meaning that they can't really exceed the federal funds rate by too much. If the Fed funds rate is low, the bank's rate is only going to be 5% maybe on like credit cards and stuff like that, maybe more in certain cases, but like generally speaking, like especially with more well-known, well-established banks, they tend to charge lower interest rates. The scummier banks will put high interest rates. But anyway, if rates are at 0 to 0.25% and banks are charging less than 10% interest on mortgages and stuff, why would it be in their incentive to start, in 2022 they start a new program with whatever department manages this stuff, but it's promoting these mortgages, sending physical mail, email marketing, whatever. And Wells Fargo was just my bank, but I'm sure other banks did this too. But like, why would you think that if rates are low and the market's starting to crash, why would they start promoting variable rate mortgages? Because when the market crashes, the Federal Reserve tends to start hiking rates to try to interfere with the crash eventually. So if the bank knows this, because they're not stupid, they've got pretty high-level traders working in certain departments of Wells Fargo. And now, look, I can't prove that they're all correlated and interconnected like this with the different departments of Wells Fargo, that basically Wells Fargo knew there was going to be a crash coming. But it seems that way to me because I'm aware that there's a market crash occurring. Wells Fargo starts telling me about variable rate mortgages, trying to get me to get locked into one. Well, think about it. If they know that rates are going to start going up, it's in their best interest to get customers to take on a mortgage for an interest rate that is going to increase. So like they may get in when rates are low, but the bank knows that the customer doesn't know, that the average customer doesn't know that rates are going to start going up. So the bank will be able to start hiking their mortgage rates, right? Okay, does that make sense? Okay, it makes sense to me because money, we all know money's a zero-sum game. So the bank and, traders, whatever you're doing, but banks included, are going to try to get the better end of the deal. So they're going to offer you a mortgage at a low rate when it's a variable rate if they know rates are about to start getting hiked by the Federal Reserve, because that means they can start hiking your interest rates and charging more money, more interest on your mortgage loan, right? Okay, so now come to beginning of 2025, 3 years later after that crash, look at this. I get an email from Wells Fargo saying, put just 3% down on your next mortgage. See how. Every dream needs a plan. Put as little, pay attention, as 3% down on a fixed rate mortgage. Okay, so this is just as important as that was back in 2022. This is vital now, right? This is very vital. Because we know that rate cuts are highly correlated with market crashes. When the Fed hikes interest rates, it can essentially prevent a crash, which is what it did in 2022. It slowed down the crash, and it made it only be about a 6-month-long crash, right? And then it recovered. And the crash had lots of bull swings in it. It had 2 major bull swings in the crash, so it wasn't like it wasn't an easily shortable crash, right? But when the federal funds rate has to get cut, when the Federal Reserve actually starts cutting rates back down towards zero, that is when a real market crash tends to happen, and that's what I think we're in right now. Now, today, price action on NASDAQ has actually been a little bit bullish, and it's kind of swinging back up, which is, not too. I mean, look, inflation's inflation. It's going to pump up the price of this, but when rates are coming down, it's disinflationary. So, this looks kind of strong, but I really have my doubts that the market's going to be bullish again. Because you can see that this right here was the effect of, hold on, let me move this. This little downswing right there was the effect of the last rate cut that the Fed did, right? And this was the market pricing in the rate cuts that it was anticipating. Now, this happened before the rate cuts, but it was so clear that they were going to cut rates, and they did cut rates, that the market started selling off right up until those rate cuts. They got priced in, and then it was bullish again, but now they're cutting rates again. So this is what's important is the next Fed funds rate decision, which is going to be at the end of January. If they cut rates again, I would expect the market to sell off more. Okay, and depending on how much they cut it or whatever, and how many more rate cuts they project, if they cut rates, the market's going to sell off. Okay, if they hold rates, the market might start it might not sell off as hard. It might still, though, if the market believes that they will still cut rates just at a slow rate, then I think it's kind of going to be a slow burn crash, but it could go down quite a bit until they hit low rates. But anyway. Okay, I kind of went on a tangent there, but what's important is a fixed rate mortgage. So I just saw in the news that mortgage rates are hitting like a 7% high. They're hitting a high right now of like 7%. Okay, well, guess what? If banks thought that rates were going to keep going up, they'd want to keep you on a variable rate mortgage, right? So that they can hike your rate. However, if banks believe that rates are going to go down, what are they going to want? They're going to want to lock you in at a 7% mortgage at its high. And then the rates start falling, but you're screwed because you're stuck in at a fixed rate mortgage, correct? You see how the game is played? Does it not make sense? Does it not make sense? You might not believe everything I'm saying, but be honest, okay? Forget the market crash theory. Just look at rates, okay? The bank, Wells Fargo, knew ahead of time that the Fed was going to hike rates, probably because of either just having good analysts or maybe some insider trading type stuff in terms of like, okay, rumors on Wall Street are that the Fed's going to start hiking rates this year. That probably spread around, behind some closed doors among big banks and stuff like that. Anyway, they clearly knew, look, in my opinion, the banks clearly knew rates were going to go up in 2022. But the thing is they tell you their play because you just have to know that they're trying to make money off you, right? Which is what a bank is doing. Any profitable business has to make money, meaning that you have to get the worst end of the deal. And in order for them to profit, you have to lose, right? Profit is a win. They make the difference between the actual fair market value of whatever they're selling you, right? They charge the difference. And whatever that difference is your loss, and that becomes their profit. That's just how business and money works. It's unfortunate, but it is the way it is. But if they are now advertising a fixed rate mortgage, that means that the bank believes that rates are going to start going down, and so they're trying to lock people in at a high rate so that even when rates crash, you're stuck at the fixed rate mortgage that you locked in at. So my opinion right now, and again, this is not financial advice. I can't give financial advice on YouTube. I'm not a certified financial advisor. Big disclaimer, right? Okay, so do your own due diligence and make your own financial decisions. However, I'm just saying, if they're trying to lock you in at a fixed rate mortgage when rates are high but on a downtrend, that's probably a sign that you shouldn't be taking on a mortgage. If you were taking on a mortgage, a variable rate one would be probably better if you're expecting them to decrease your mortgage rates, right? Or if you're expecting the average mortgage rate to decrease around the world and around the country, you'd be best off at a variable rate right now, right? And the best time to get in a fixed rate mortgage is somewhere like 2022 when rates are already low, right? When rates are low, that's when and again, I can't give financial advice, but this is just basic knowledge, right? You want to get locked in at a low rate. So you want fixed rates when rates are high, when rates are low, you want fixed rates, and when rates are high, you want variable rates, right? It's pretty simple. But anyway, so I just believe that this is more writing on the wall that rates are going to keep going down. And if rates keep going down, I'm of the belief that this market will sell off hard. Very hard. Because all you have to do is look at the history, and every time that there's a series of rate cuts, and the banks adjust their lending programs to the rate cuts, the market sells off hard. And you can see it here. Rate cut happened in December, market sells off. Rate cuts were going to happen here. It sold off before, which makes it a little confusing, but yeah, there was this is a 17% decline. That's almost like a bear market is 20%. So in about, what was that? 1 month, losing 17% in 1 month, that is a crash. Okay? It's a pretty big correction. Anyway, so if rates are going to keep going down, again, this week has been a bit, or the past week has been kind of bullish. I'm not going to lie, but if rates get cut again at the end of January, I really see this selling off. So anyway, that's just my 2 cents. Take care, guys, and I'll see you next time.